Now let's bring in Tom Lee. He is managing partner and head of research at Fundstrat, the man who called the so-called everything rally. Tom, welcome back. Things are falling into place pretty nicely for you.
Yeah, thanks, Scott. It looks like markets are positioned and to rally into year end. I think investors have to be aware that the bond market this week really started to deliver signals that are strengthening this rally. I think that's why there's been this improved resilience.
The 10-year falling, what's the message there, do you think? Because it's a surprise to many, I think, for obvious reasons.
That's right. The 10-year yield falling is a dovish development because over the past 8 weeks, the bond market was starting to fight the Fed view. As you know, the bond market was starting to push for rates, 2 hikes or 3 hikes in 2022, and then a tapering that was causing pressure upwards on yields. And I think the weak GDP print, the productivity miss, and then this pill from Pfizer are really starting to take away that inflationary pressure. And it now looks like the bond market's coming to the Fed's view, which is great news because that means that if yields are falling and there's less inflation fears, equities have room to run.
Tom, let me ask you this. Let me try and sort of get inside the mind of Tom Lee, bring our viewers inside there as well, if I could. What led you to believe that stocks could hit 4,800 on the S&P by the end of this year? What enabled you to get so bullish when you did, that you thought we could get that so-called everything rally that seems to be happening as we speak?
It's anchored on 4 things. One was, our continued belief that S&P profit margins would surprise because of what we call the unkillability. Businesses survived the worst shutdown in 7 generations. And when we saw this in tech and discretionary, margins really rose, and that's what's happening. We think S&P earnings next year could be 230, 240 versus 220 consensus. The second is we know there's tons of pent-up demand, and that if COVID was alleviating, that would start to be unleashed, and we're seeing that. The third is relative value because, bonds are expensive. You're paying 64 times earnings to get a 10-year, 25 times to get high yield, or you can pay 18 times for equity. So I think equities are still cheap. And the fourth is just from a general positioning, many of our clients, not most, but many, are sitting on very uncomfortable cash positions. And they've been waiting for that 10% pullback. Not that we've been calling for it, but they've all had that as a consensus view, thinking the Fed was going to trigger it. And now that it doesn't look like it's happening, that money gets put to work.